Assessing U.S. debt issues. Debt-to-GDP ratio at highest since World War II. The United States national debt has reached over $33 trillion, with a debt-to-GDP ratio of 120%, the highest level since World War II. Many people are concerned about when the U.S. debt issues will become a problem. To determine this, it is important to look at the right metrics when assessing personal financial situations. Individuals often consider their net worth, assets minus liabilities, and their income versus expenses. Similarly, for the U.S. government, the most important metric to consider is the cost of servicing the debt compared to GDP. The U.S. government has the advantage of being able to tax, borrow, and print money. They have a monopoly allowing them to take any amount of money in taxes. Additionally, they can borrow money at below market rates and call on the Federal Reserve to purchase their debt. These methods allow the government to increase their income to meet necessary expenses. The importance of managing national debt. Examining debt to GDP ratios and interest payments. However, there is a limit to how much debt the government can accumulate before it leads to hyperinflation and a collapse of the currency. Examples of hyperinflation can be seen in countries like Argentina, Venezuela, Lebanon, Turkey, Zimbabwe, the Weimar Republic in Germany, and even the United States before the Revolutionary War. Some people believe that debt-to-GDP ratios of 90% or 130% are tipping points. The more important metric to consider is the interest payments or the cost of servicing the debt compared to GDP. Currently, the annualized interest payments on the national debt exceed $1 trillion per year. By dividing the interest payments by the GDP, it is possible to determine the percentage of GDP that goes towards servicing the debt. Currently, this percentage is around 3.6%. This may seem low, but historical data shows that anything above 4% is considered abnormally high. Projections indicate rising interest costs on national debt pose long-term burden on economy. Looking at projections for the future, it is estimated that by the end of 2024, the interest cost on the national debt will be around $1.2 trillion. If GDP continues to grow at the same pace as in Q3 of 2023, the total GDP will be around $29.8 trillion. This means that the interest cost will be approximately 4% of GDP. If GDP does not grow or even declines, the interest cost as a percentage of GDP will be even higher. It is important to note that these projections are based on current interest rates and debt maturity, which can change. While the interest on the national debt may not be a problem in the short run, it is expected to become a burden on the economy in the long run. Higher interest rates will lead to increased borrowing costs for the government, which can impact economic growth. However, it is important to consider how to take advantage of higher interest rates and potential declines in asset prices. Managing investments and mitigating risks amidst national debt concerns. Investors can allocate their investments to assets that benefit from higher interest rates, such as treasury bills or money market funds. Additionally, investors can take advantage of opportunities in bear markets by hedging their equities or profiting from downside moves. Overall, while the U.S. national debt is a concern, it is not expected to lead to a sovereign debt crisis or hyperinflation in the near future. However, it is important for individuals to manage their own finances and investments wisely in light of these potential risks.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.